Good morning, Bitcoiners. Hello, and welcome back to your Bitcoin economic calendar. I'm Mauricio Di Bartolomeo, co-founder of Ledin, and as with every Monday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Monday, October 4th, and we have an episode full of insights for you this week. Today, we're going to start by talking about the first US Bitcoin ETF, which could be approved in 14 days. We're going to take a look at those applications and what are the odds of those getting approved based on some of the analysts that are covering these ETFs. Second, we're going to be looking at the US labor market and breaking down some of the latest numbers and what we can expect from some of the reports that are scheduled to come out this week, how those may impact markets. And lastly, we're going to look at inflation in the United States, which shows no signs of stopping. So grab your coffees. It's going to be a great one. Starting as we usually do with Bitcoin, we see that it was a very good week price-wise for Bitcoin, closing the week up by 11.65% at $48,235. From a technical standpoint, we saw some pretty positive price action, and I'm just going to highlight some of the arrows here on the volumes. As you can see here, this is on the daily chart, and I'm just going to go out to the daily chart so you can compare the chart that I'm looking at live with the ones with the arrows. The main thing to highlight with the arrows is this correlation between rising volumes as well as rising price action. And we wanted to spot the last few times that this has happened throughout recently, dating back in August, essentially dating back to July, August, and September. And we see here as the orange lines are aligned that whenever there is a rise of a price increase with rising volume, this tends to be a longer term trend in Bitcoin prices. So again, we saw increasing volumes in Bitcoin basically for Wednesday, Thursday, and a big jump on Friday after Jerome Powell's comments. These are the three green lines here. Just going to take this back to the chart. These three green lines here that are seeing it increasing, this is essentially Wednesday, Thursday, Friday. So as you can see, price is rising along with volume, which tends to be essentially the beginning of, as we've seen in the past, when Bitcoin shows these rising volumes with rising prices, it tends to be at the early stages of an upward trend. So interesting to keep this in mind now that we've seen that the volumes are rising along with price. So as we mentioned, there were some really strong comments last week out of the SEC and the Fed, and those did play, in our view, into the price action that we saw for the week. But again, before we leave on the technical stamp, just a quick last glance at a couple of technical interesting features here is, for one, these support and resistance lines, again, which have not moved in about 4 weeks, continue at play. We see that last week, the weekly candle did hold that 43,000 support, and it did hit that 48.8 level, and it seems to have been rejected, and essentially is sitting at the around 48K right now, essentially. So breaking down what came out of regulators last week, on the time, as you mentioned, the timing of the rally really coincided with positive statements out of U.S. officials. So let's break those down. First, on Wednesday, SEC Chairman Gary Gensler reiterated his support for a futures-based Bitcoin ETF. And he did cite, as he was making these comments, he did cite the futures contracts for Bitcoin that currently trade at the Chicago Mercantile Exchange. And here is a copy of essentially the article that highlighted Gensler's comments. Now, as a reminder, the SEC is scheduled to make decisions on 4 Bitcoin ETF applications this month. The relevant dates are still a few weeks away, on the 18th, on the 19th, and 2 applications on the 25th. But the chart that you have on your screen, which is courtesy of Bloomberg Intelligence, shows the applications that are scheduled to hear a decision, as well as the odds of them being approved. And we're going to break down those odds and why they vary so much across different projects. So the first futures-based application scheduled to hear a decision is the ProShares Bitcoin Strategy ETF, and that is scheduled to happen on October 18th, so exactly 2 weeks from now. As per the chart on your screen, Bloomberg Intelligence is projecting a 50% chance, so 2-to-1 odds, of this ProShares Bitcoin ETF being approved on that date, on the 18th. The second highest probability, which is basically 1 in 9, is the Invesco Bitcoin Strategy ETF, and then the last one, which is 1 in 20, the first one is the ProShares Bitcoin ETF, which is 1 in 2. Then the next one up is the Valkyrie Bitcoin ETF, which is a 20% chance of getting approved, which is 1 in 5. And that is the second futures-based application that is scheduled to hear decision. So again, very important dates here: October 18th, October 25th. These are the two ETFs that have the highest chances of getting approved. 50% on the ProShares ETF, 20% on the Valkyrie ETF. So again, 2 weeks away, but very important to keep this in mind, and we'll break down why. As we saw when big events happen around Bitcoin, similar to what happened with the Coinbase IPO, October 18th may act as a magnet for Bitcoin prices. Again, similar to what happened with Coinbase's IPO. We might witness a hype wave in the coming weeks that drives prices higher, running up or leading up to this announcement. If this happened, keep in mind what occurred once Coinbase went public, and remember the old adage, which just basically says, buy the rumor and sell the news, which typically means that assets tend to rally towards a hype, and then once the hyped up event occurs, assets tend to sell off. So keep this in mind. So on Friday, moving on from the SEC, on Friday, Fed Chair Jerome Powell stated to Congress that he, or the US Fed, has no plans to ban Bitcoin or cryptocurrency. This is the headline that you see from the Wall Street Journal that came out on Friday. And Powell was specifically asked about the ban in China, and point blank responded that the US has no plans for anything similar. Powell cited stablecoins as citing potential financial risks, and that the Fed's intention is to get participants to comply with existing frameworks. In this same week, the chairman of the Federal Reserve and the Securities and Exchange Commission made favorable statements for Bitcoin. The powerful combination had an impact on prices, and this impact should carry forward. Another signal of growing institutional appetite outside of the US came out of Morgan Stanley's Europe Opportunity Fund last week. We're just going to move over to that headline. And as you can see from the headline from Business Insider, according to a recent filing, the fund, the Morgan Stanley Europe Opportunity Fund, disclosed that it held 58,116 GBTC shares as of July 31st, and this is up from 28,298 shares, which it disclosed on April 31st. Institutional appetite for Bitcoin in this fund doubled in 3 months. To put that in perspective, at that pace, this demand would grow by 16 times over the course of a year. That's massive growth in investor interest on this front. So we'll touch back on a few more things that we're seeing on Bitcoin in our What's Ahead section later today. Moving over to the S&P 500 and equity markets, we see that equity markets suffered a meaningful drop last week as they continue to digest the Fed's tapering plans. The S&P finished last week down 2.15%. The Dow Jones dropped by 1.36%, and the Nasdaq finished last week lower by 3.51%, being the biggest loser. We are seeing some continuations of those down moves again this morning. Last week delivered a series of news that resurfaced inflation fears, pressuring the Fed to start/continue moving on its tapering plans. Inflation signs are everywhere again, and we're going to break those down. First, let's look at US households. The chart you have on your screen right now is US rents, US average rent, and you can see that that number is up 11.5% in August from a year ago today. This represents a cash payment of $200 a month higher for the average American renter. A concerning factor here on the rent side is also the low base effect. So in other words, rents came down during the pandemic. And to illustrate this, we're going to look at the average index for all urban consumers in rent. This is data from the Fed. So as you can see, this number basically halved between 2020 and 2021. It went from 4% to essentially less than 2%. What this means is that not only do rents have to rise to catch up, but they also have to rise because they're continuing to shoot higher as home prices are now way above what they were pre-pandemic. Going into home prices, stepping outside of rent into home prices are no different than rent. So according to the S&P Case-Shiller Index, U.S. home prices in August soared by 19.7% from a year ago. That's higher than July's increase of 18.7%. So prices in homes, like the increase in home prices, is accelerating and not showing signs of slowing down. This is great news for homeowners, but would-be buyers are being left in the dust. We also saw an uptick in the used vehicle value index, which had soared earlier in the year, but had started coming down. It basically ticked back up into life last week, which again is showing some signs of inflation just not letting down. Now, in parallel, as this is all happening, supply shortages are leading countries in general to step up their energy demands to meet their reserves and secure energy independence for the upcoming winter. We're seeing some of this play out in Europe. And again, the best place to look at where these prices are playing out is European natural gas prices. This is largely being driven by Russian production and exports, and this deserves a different episode on this topic. But essentially, you can see very clearly that natural gas prices in Europe are running up as countries look to stack up for the reserves for the upcoming winter. Additionally, just staying within the energy realm, we're seeing that West Texas Intermediate crude, which is essentially one of the most closely followed measures for the oil barrels. The oil is just booming. It's up from $60 to $80 in literally September and August. So it's rising quite fast. We're seeing oil essentially catch quite a strong bid. It has basically now obliterated this resistance that it had at the $77 range. And to show you how investors are looking at this and positioning themselves, we saw some very interesting headlines last week that there is some activity in the oil options market that is placing, which has some investors placing call options on a $200 barrel for December of next year, which again, quite interesting to see investors already start to either speculate or try to hedge some of this potentially very large move in oil prices. Now, to make matters a little bit worse, all this is happening while manufacturing in China for new export orders for factories has once again contracted for the first time in a really long time. So again, if you look at the yellow line, which is new export orders for factories, we see that this line had been essentially, growing and finding its level right around the 50%. And we see that it has decidedly started contracting once again and seems to be accelerating a little bit into the fall. So this could lead to even further upward pressure on prices and inflation. And while it seems that the Fed has decidedly chosen to take action to start tapering essentially and start letting interest rates rise, Janet Yellen out of the U.S. Treasury wants to maintain some fiscal room in case more or new measures have to be taken. And again, this is the article that I'm mentioning, Janet Yellen basically voicing her support for efforts to remove the U.S. debt ceiling altogether. This would theoretically mean that the U.S. could be indebted into infinity. And we would expect the debt ceiling debate to pick up steam in the coming weeks, potentially if the markets continue to trend lower. And this, the back of your screen right now looks a bit serendipitous with the big red flash, the Dow Jones at the top, and the article calling for Yellen asking for removing the debt ceiling. So quite poetic this morning. So the trend for bond yields to continue rising and markets to remain under pressure are likely poised to continue unless something changes. Moving over to our analysis of gold, we see that U.S. inflation markers hit new highs last week, and the yield on the U.S. Treasuries sold off. So this, all in all, have helped gold inch higher for the week, closing up 61 base points at $1,760 per ounce. Now, gold's price action was commendable last week, especially considering that the US dollar index also rose by 85 base points in the same week. We're going to illustrate here this on the dollar index, which again, we know that when the dollar index rises, this typically puts headwinds on commodities, including gold. So again, we see the dollar index rose by almost 1%, and we also saw gold rise that same week, which is quite commendable. The compression of the real return in U.S. Treasury bonds was able to compensate for a rising dollar and help gold inch higher. As we've covered here in the past, there's a negative correlation between the real return of U.S. Treasuries and gold. To illustrate how real this correlation is, and again, remember that gold has a negative correlation to the real returns of the Treasury bond. So we would still need to subtract inflation from these yields, but at a high level, they show a quite clear correlation, which we wanted to highlight. So first, let's pop up the chart for gold, and that's the chart you have on your screen right now. And we're going to make this chart on the daily, just so that we can see a bit more clearly. And we're going to compare this with the yield on the 10-year. So as you can see, the correlation between the two is pretty much negative. They are inversely correlated to each other. And again, I think this is quite clear. As you go out further into the dailies, the moves on Bitcoin and the 10-year have been so wild that it's hard to see that. But here it becomes quite clear. And so yes, the yields. Just to go back to what's happening to yields and how this could play into bonds. As yields on the U.S. Treasury bonds are poised to rise, remember, the Fed is going to remove its purchasing of these bonds. So what is going to happen is these bond prices are going to come down and the yields for these bonds are going to come up. This should act as a headwind for gold between now and the end of the year, because we know that the yields are going to keep rising, and it seems as inflation has already started peaking. So provided that the yields keep rising and inflation stays the same from here out to the end of the year, this should put headwinds on gold's price action. Moving over to our DeFi analysis, both the DeFi index and Ethereum soared last week. We're just going to pop up the weekly charts here so we can illustrate. So as we mentioned, the DeFi index closed last week higher by 11.28%. Ethereum closed last week higher by 11.52%. We noticed that actually both of them underperformed Bitcoin to the upside, with Bitcoin closing higher by 11.65%. So not material, but still relevant that Bitcoin did move higher than both of these other assets. The interesting thing from a positive standpoint around Ethereum is that it did close right around or above this very important 3,300 and change level. It closed decidedly above that at 417. So clearing that 3,300 mark was quite important from a technical standpoint. And the big news that came out of the DeFi space last week was courtesy of the Compound protocol. We'll highlight that news in a second. And the headline in your screen comes from CNBC and highlights that after deploying what should have been a standard upgrade last Wednesday, a bug made the Compound protocol pay out $90 million in comp tokens to protocol participants. The news made waves for a few reasons. First, Compound has been widely seen as one of the most mature protocols, managing almost $10 billion in total value locked. A $90 million accident is not an insignificant problem, and it is a reminder that a bad code update in DeFi could put billions of dollars at risk with a couple of clicks. Second, how the protocol responded or reacted to the issue was also a bit concerning. The founder took to social media in a somewhat threatening plea for users to return the accidental payout. And this is the tweet that we are mentioning. Ironically, the founder was quick to mention the IRS, the Internal Revenue Service out of the United States, as well as the client's identities, both of which are rather antagonistic to the spirit of DeFi. The price of comp tokens seemed unaffected by the event. It did have a slight drop, but it has since recovered. And while the mistake was in favor of users, we will keep our eyes out on the total value locked levels on DeFi protocols in general to see if this event prompts any institutions to slow down or reconsider their positioning in the space. And moving over to our Bitcoin mining difficulty commentary, the next difficulty adjustment should kick in later this evening and is projected to bring difficulty up by 3.16% to 19.67 terahash. Hash rate continues to bounce back after the crackdown in China, and on that topic, we continue to see the fallout of the Chinese crypto ban. Last week, Alibaba, and we're just going to pop up the headline, last week, Alibaba announced that it would stop selling crypto mining machines on its website. Another blow to this was another significant blow to a sector within Chinese commerce and manufacturing that had surely had been roaring for the last 5 years. At the same time, the great mining migration from China to the United States continues to become a meme in a good way. Last week's article from Forbes, which you have on your screen right now, reinforced this narrative and highlighted Austin, Texas as one of the premier destinations of the new mining migrants. We expect this trend to continue and potentially accelerate if Bitcoin prices hold or continue rising. And as always, we leave you with what's ahead for the week. As we've mentioned here in recent episodes, the Fed is going to be zeroing in on US labor market data. And we have a lot of labor market data coming out this week. So with that in mind, let's take a quick look at the state of the US labor market and how the market could react to the upcoming data this week. So to break it down, the current unemployment rate in the United States is sitting at 5.2%. The Fed's goal is to get unemployment to its natural rate of unemployment, which the Fed believes to be 4.4% right now. So we're still percentage and change away from getting there, actually 0.8% from getting there. There are 2.8 million people getting unemployment benefits as of last month, while at the same time, companies have more than 10.9 million open jobs as of the month of July. Yes, people are moving from factories to tech/gig economy work at an alarming rate. However, those who cannot retool their skills may be left behind. This is often defined as structural unemployment. Let's take a look at some data. The chart you have on your screen right now is the US unemployment rate. Notably, and let's start getting into some of the data that we're expecting to see this week, but suffice to say from the chart that you see the big COVID spike that basically happened once we had the pandemic. And we see that essentially the key level to watch for is this 5% line. And we see that the US defines natural unemployment as essentially just below 5%. We see that during the pandemic, this level rocketed to 15%, and it has been coming down aggressively. But this last little percent could potentially be the hardest one, and we'll get into why. So notably, the expectation for new non-farm payroll jobs added this month of September, so this is the expectation for the data that is coming out this week, observants or market analysts believe that the range should be from an increase in 235,000 jobs, between 235 to 373,000 jobs are going to be created, net new, in the month of September. At the same time, the expectation for new jobless claims reports, these are people submitting new requests for an employment benefit, is expected to jump by 362,000 people. This means that theoretically, only around 10,000 net new people are entering the workforce throughout the month of September. This is partially why the unemployment rate for September is predicted to remain at 5.2%. The gains in the labor market seem to be plateauing, which the Fed does not like to see. Some may attribute this last bit of friction to negotiating power by employees taking a stand to increase their wages, which is the optimistic view, as they would eventually enter the labor force soon at a higher rate. We can see some of this already happening in the projected 0.6% increase in monthly average hourly earnings for U.S. workers, which is actually coming out this week. And again, it's projected to show a 0.6% month-over-month increase. That's a 7.2% annualized increase, which is actually great for the American worker, but it highlights how much companies are having to pay up. The not so rosy view is that this last stretch of unemployment, this last bit of unemployment, is more structural in nature. And this means that people will require way more education and training before they can re-enter the labor market. It could also be a combination of the two drivers. In either way, this week's upcoming labor data will be very telling. Lastly, Evergrande, the troubled Chinese property developer that may be facing bankruptcy, managed to stay out of the headlines last week, but the fear still certainly lingers. A positive announcement out of a rescue deal from the Chinese government could potentially cause markets to rally, while the opposite is also true if we hear a formal bankruptcy proceeding announcement. So, as always, we wrap up the episode with a summary of the upcoming economic data that we have for the week. And we'll go back to the other view. So, on Wednesday at 8:15 a.m., we get the ADP employment report for the United States. Expectation here is for an increase of 373,000 new non-farm payroll jobs in the United States for the month of September. This is slightly lower than the increase we saw in August of 374,000. And there's a lot more employment data coming out throughout the week. So let's go on to the next one. Thursday at 8:30 a.m., we get initial jobless claims. These are new requests for unemployment benefits. That's scheduled or predicted to jump by 362,000. And we hear also from the continuing jobless claims, people that already filed them but are continuing to file this month. And that number sits at around 2.8 million people. Lastly, on Friday, we get the U.S. unemployment rate for September. Again, the prediction here is that it should stay at 5.2%, not move from August. And again, also at 8:30 p.m. or a.m., we get the U.S. non-farm payrolls for September, as well as the average hourly wages for September in the United States. Again, investors will be paying close attention to labor market data this week, and markets could react to the information as it comes out. Remember that any positive surprises, so numbers that come out such as more new jobs than expected, this would likely cause markets to sell off, while negative surprises, i.e. more people filing for unemployment benefits than expected, would likely be cheered by the market. And this all ties back to the Fed, as bad news means the Fed needs to maintain a more relaxed fiscal policy for longer as the labor market continues to recover. So we covered a lot today. It was a pretty jam-packed episode. If you have any questions, if you have any comments or feedback, we welcome you to throw it in the comments section down below. If you enjoyed the show, if you learned something, if you want to share it with your friends, we welcome you to thumbs up it, like it, and subscribe it, and email it to your friends so they can come check it out. And lastly, if you don't have a Ledn account, I welcome you to check out ledn.io and learn how you can start earning up to 6.1% on your Bitcoin, up to 9% APY on your USDC, and you can get the best rates on loans if you have Bitcoin, need cash, but don't want to sell your stack. Thank you, everybody. Have a wonderful week, and see you next time.